Welcome to another exciting edition of the Trading Bell. Today we are coming to you from Upper Hill, one of the financial centers in Kenya. A lot happening in the various spheres when you look at the investment climate. A lot of concerns also being raised around risk and how do we ensure compliance. Kenya recently played host to a very big conference that saw various stakeholders being part of this. And the gentleman I'm about to announce to you is one of the key figures who was at this particular forum. And welcome to the show. Let's just say jumbo to Kenyans as you introduce yourself.
Hello, thank you very much for having me here. So my name is Seyfi Gunay. I'm responsible for the risk and the compliance business within Refinitiv as part of the London Stock Exchange Group. And again, thanks for having me here.
All right. And let's just begin by giving us a sense of appreciation of really how is the lay of the land when you look at, you recently had a very interesting conference, and what are some of the key issues that came out from the participants, from the other speakers? What struck your mind?
So first of all, it's great to be back in Kenya, that's number one. And it's also great to be back seeing customers. So this is an event after COVID, 2 years, we are doing in-person events. So what we thought is very important with the recent geographic developments to have an event in Kenya to bringing all in the compliance professionals and to discuss recent developments when it comes to global sanctions. As you may know, it is really a hot topic around the world, what's happening in Ukraine, what's happening in Russia, and that is impacting a lot of our customers around the globe. And in Kenya, we spent the whole afternoon, the morning and the whole afternoon to discuss recent developments and to discuss what kind of ways to mitigate these risks for the financial community in Kenya.
All right. Just talk to us about how big is the exposure that we are currently seeing when you look at the risk, as well as how are we also fitting in when it comes to compliance?
So when we look at the numbers, to give you one numbers, these are numbers from April this year, so we have more than 40,000 sanctions, individuals or companies on global sanctions list. So these is a very high numbers, but the complexity comes really, it's not the direct sanctions. These people have affiliates, they own companies, they have spouse, they have partners, so it's a very complex theme when it comes to capturing compliance. So it is getting very, very complex and very time consuming for our customers to keep up with the space. We as Refinitiv, we are providing solutions in order to mitigate these compliance risks, whether it's for financial institutions, for corporates, or newly technologies like the fintechs.
All right, and 40,000 is not a small number, if you ask me. Perhaps talk to us about how does this really translate when it now comes to getting the real work done for various professionals like yourself?
So the goal is very simple. So the rule says you should not do business with people or corporations which are sanctioned. That's a very simple rule. But the details is very complicated. So you need to identify. So you need to have products and services in place which helps you to give you a list of all these sanctions entities. So once you have these, you have to screen your own portfolio, your customer base against this list. These lists are dynamic, these are changing, so just from an EU perspective, what I can tell you, we had 6 sanctions package within 3 months. So it's a very dynamic. So it is important for our customers in Kenya to be up to speed in order to mitigate that risk. Because if you miss one company and you're dealing business with, people always say compliance is expensive, but being not compliant that's really, really expensive.
Interesting indeed. And paint for us the big picture. Of course, for Kenya, sitting right in the heart of East Africa, there's a big interest in organizations complying, and perhaps how can this be further accelerated, especially when it comes to capacity building and giving knowledge when it comes to areas that are potentially volatile, that we need to really have a good radar up when you look at how corporates are operating right now?
I think there are 3 core elements which are really important in order to being compliant. One is the complexity around the data. So you need to have a clean data set in order to be compliant. That's number one. The secondly, what we are seeing more and more in the market is the use of technology. So we are seeing finding the right balance between the technology and the human capital. And third but not least is really the knowledge, and that's why we had this conference today, bringing more than 150 compliance professionals together, sharing thought leadership, sharing best practices. So I think these three core elements are very important in order to have a very resilient and competitive and a speedy compliance system program in place.
All right. And of course, looking at the various stakeholders that are taking part in this conference, it would be interesting to hear from you. What were some of your big takeaways when it comes to seeing the level of compliance? Are we doing a good job at it? Are we missing the mark? How best can we further up our game?
I think Kenya is on a very good way. So we had not only this conference, but the whole week we had a couple of interesting conversations with our customers. And what we are seeing really is leveraging the technology more and more. So there are some companies out there which really have a very high volume of transactions, whether it's in the payment space or in the digital space. So in order to cope with that, you really need to have the right technology. And my observation is that more and more technology, artificial intelligence, machine learning is getting more and more use. So it's like Kenya is definitely on the right path, but I think it's still a long way to go.
All right. Speaking about use of technology, I'd also want to pick your mind, especially now that you've brought this up. When you look at the entire ecosystem around countries or individuals that have ended up being in the list of sanctions, just give us a sense of what is the impact this has to an organization. And of course, we've also seen what's happening right now in Russia and Ukraine. How severe is the matter, and how serious should people take this?
Well, look, it's like when you are doing business and you have some problems in order to identify your suppliers or your customer base, I think you are carrying a very high risk when it comes to reputation. So it's like no one wants to be in the press or wants to face a regulator for not being compliant or having customers onboarded which are sanctions entities or sanctions corporations or sanctions individuals. So I think the biggest risk is really the reputational risk, which has an impact, dominant impact on other customers. So people not necessarily want to do business with you if you don't have the right things in place in order to do business. So it's not only a standalone risk, it has, you were talking about the ecosystem, so I think it impacts, at the end, it impacts the whole financial system and the reputation of the country as well.
All right, interesting. And as we come to the tail end of our interview, I'd like to know more about when we look at the globalization that we are seeing, the integration of the financial market system, from where you sit, what sort of risks are currently dominating the sector, and what do you see in the horizon that might be more complex risks that could literally hit the soft underbelly of the financial system?
I think the biggest risk is the complexity. So I gave you an example about the sanctioned securities, for example, when it comes to investing in financial instruments. So I think when you look at equity and bonds, that's quite simple to identify that. But then when you look at funds, for example, or ETFs or derivatives, so where really sanctions instruments or securities are included in an ETF, are included in a mutual fund, then it's really getting very difficult to identify this. I think you have to rely on data provider who give you access to really identify and screen everything. So I think the biggest risk is really the complexity. You might think, I have not invested in a sanctioned company A and bought this financial instrument, but you might bought a financial instrument which is a mutual fund, and in that mutual fund you can find this sanctions A company. So it's the complexity, I would say, is the biggest risk. And in order to mitigate that, again, you have to efficient systems in place.
All right. And last but not least, what are some of the tips you can give our viewers and those amateur investors when it comes to what to look out for before invest, especially now that we are in an era where you might want to invest in an organization and you might not really know whether they're sanctioned or not. What are the do's and don'ts?
I think my advice would be to work with financial advisors or with a company you feel confident and you have the confidence and you believe they have the right systems in place in order to protect you as an investor, not to make the wrong decision. So I think my advice would be to really to look with the company, again, do your own due diligence with the company you are working with and feel confident that they have the right systems in place in order to protect you from wrong decisions.
All right. And of course, we hope to be engaging with you the near term, especially when it comes to just breaking down all these complex matters to our viewers. Many thanks for your time.
Thank you very much for having me here. Thank you.
Well, we've been having that very interesting discussion, looking at various aspects touching on risk and compliance. And the entire ecosystem is undergoing an interesting evolution as we have come to describe it here. But of course, for more on this, you can always catch us every time on the Trading Bell. For now, we want to wrap it up with a quick look at how the financial markets are performing.
Hello and welcome to Trading Bell Market Analysis. I'm Nokip Kimboy. This evening I'm joined by Samuel Gishohi, who is the Head of Business Development at NCBA Investment Bank Brokerage. And we want to take a look at the way the markets are performing. Just looking at these counters, quite an interesting movement you've seen over the past week or so. Let me just open that. So for gainers, some actually, I can see Liberty Kenya, Carbasid Investment, Stanley Fahari, and these are moving up the normal numbers, 9% up, 7% up, 3% up. Looking at that, maybe talk to us about, for the gainers, what stands out for you?
As you can see, we don't have any of the big players on the gainers and the losers. But if you look at the volumes, you find that most of the volumes were sitting on KCB, EABL, Safaricom, and Equity. So that really indicates that, of course, the gainers and the losers, sometimes, when the market is has very low volumes trading, because what we've seen during this period is very low volumes of trade. It means that then you start seeing the likes of Stanbic, TransCentury appearing on the gainers and the losers. I think on the losers you may see, for example, Safaricom, which has seen quite a bit of fluctuations on the price. But generally, this is really a back and forth between the foreign investors who are net sellers on Safaricom and the local investors who are feeling that Safaricom, which bottomed out at around 24 about 2-3 weeks ago, is still in a very good buying zone, and they're trying to scramble and pick it up before it goes out of their reach. After we saw a short spurt of foreign buying sometime the last 2 weeks. So I think that's the only thing that maybe out of the ordinary that could have happened. Investors still accounted for about 51% of what was happening with the market, but they're still net sellers, because we saw them withdraw about 0.62 billion from the market. It's not much compared to what we've seen in the past. What I can say is, as we approach elections, and this has been the case over the last 3-4 election cycles, we usually see volumes drop drastically. A lot of investors towards the election will take a wait and see position. They will sit back and just put their money in safer havens, like fixed income accounts or fixed deposits until after the elections. Foreigners will also not be trading a lot. They will be more interested in what's going on, and what's going to happen in terms of, especially now that we're going to have a regime, a complete regime like reshuffle. So basically, we don't expect much activity this week and next week as we go towards the election.
Okay, and you've mentioned that. I'm thinking about, people being encouraged to buy during this dip, with a lot of pullout and many counters, especially the major players, going down the Safaricom's. A lot of people are being encouraged to buy. How are we seeing that counter narrative of safety and now raking up stock while it is still quite affordable? How is the market, responding to that?
Well, you have to factor in the fact that inflation is also, at high, and the government, the CBR rate, of course, has been. We expect it to increase and has been increasing. So we expect it to go up by. It's at 7.5%. They probably take it up again by another 50 basis points. Inflation is at 7.9%. Now, that means that as rates go up, then there's more attractiveness on the fixed income side. Although even with that, we did see the bonds that were issued last week undersubscribed. Or the last issues that were done undersubscribed, which means that one, there is low liquidity in the market. Two, when there's inflation, there's also a lot of pressure in terms of liquidity, and it also means that a lot of investors are probably strapped for cash at the moment, and you see markets are usually moved by disposable income. Now, we are trying to encourage people to buy now, but again, it just happens to be a time when cash is not available, and so it means that we're not seeing as much participation. Of course, those investors with something, some disposable income available, I would really strongly advise that this is a very good time to be taking their positions. But unfortunately, for a lot of investors, either they have already taken their positions. A lot of the activity we saw in the last 2 weeks was also profit taking. Remember, Safaricom, for example, went from 24 shillings up to around 33 at some point. And so there was quite a bit of profit taking. And maybe those ones will probably move them, be able to reinvest those funds in this period. But with with disposable income being under pressure, with inflationary pressures, and of course the USD, of course, strengthening against the shilling, which also exacerbates the inflation pressures, it is a difficult time for anyone to invest, but it is the right time to invest.
Thank you very much for that. Now we want to take a look at some questions that we've received from our online audience. The first one actually is, and this is the question that we'll tackle today, is about purchasing shares, which is very important. But in our mobile money system and the way the ecosystem that we operate in, people are gathering bonga points. And for the longest time, we've used bonga points to purchase phones, sort of complement our day-to-day financials. So in terms of playing in the markets, how does one purchase shares via bonga points?
Yeah, that was actually a very interesting, good way to actually monetize bonga points. Kudos to whoever came up with that idea. To buy shares, you go to the bonga points screen and you go to Lipa na bonga points. Once you do the Lipa na bonga points, you go to the pay bill number. Now the pay bill number you're going to put in there is the pay bill number that will help you to move the bonga points into the pay bill of whatever brokerage firm you are listed with, because any shareholder who wants to buy shares will have to fund their account in order to do that. So for example, NCBA Investment Bank, our pay bill is 488522, and then you'll use the account number. You will enter CDSC, your CDSC account number, just the number. I know that sometimes people will see the CDSC number has a big number of zeros several zeros, and then there is a stroke LIO or stroke, depending on whether you're a local investor or company or whatever. Just a number. So if it's 0001234 stroke, so then after the CDS number, you put in the amount of money that you're going to put, and note that the number of bonga points is, I think, 5 times. It's times 5. So 5 bonga points, I think, will translate to 1 shilling. Then you'll put in the Pesa PIN, continue, and once you pay, your money will now be in your account, and you can be able to place the order on the online platform, or of course, if you're an email, you want to do it via email, then you can send us an email to do the purchase. But it makes more sense to just do it on the online platform.
And now on Market 101, what is day trading and how does it work?
You to buy and sell a particular stock severally within the same day. Now, maybe to explain this, I would like to go a bit backwards into the difference between day trading and normal trading. When you're trading normally, the assumption is that the funds for that trade will settle in 3 days, T+3. And if you go back, you'll note that that's how long it would take in the past for a check, which is probably the worst case scenario for the funds to actually change hands or to settle in an account. So in the normal way, it means that you buy shares, you can't sell them until they are fully yours, which will take 3 days. But with day trading, it gives you the ability to buy the shares now, and 2 hours or 3 hours later, you can go back and see the shares have gone up, say, by 1 or 2 shillings, depending on what reason it is you bought them for, what expectations you had, and then you can the shares again on the market the same day. Once those funds are in your account, you can look at another share or the same share, and you still feel you can, it's dipped, and you can buy it again and sell it again within the same day. It allows you to do that. So day trading just means that you're able to churn a single stock more than once, as in buy and sell it within the same trading day, vis-a-vis normal trading where you have to wait 3 days for settlement to happen. It's good because especially when we have, for example, I mentioned that several corporate actions happening today, on a day when, say, a company's books closure is happening, or they have an announcement that you feel will cause the share price to shift significantly. Because in the Nairobi Securities Exchange, a share can only go up or down by 10% of its opening price on any trading day. But when there is a corporate action, dividend announcement, maybe they have announced their result, I think that share can go, anywhere. The 10% cap is removed. And that means that on a day like that, a lot of investors would probably expect a very good announcement from a particular company, and they will buy the share maybe early in the morning and expect that because they expect a good result, then that share might go up by 10 or 15% during that trading day, and so they want to take advantage of that opportunity to sell it within the same day. Under the old system, it means they would wait 3 days, and by the time the 3 days are over, the chances are that that opportunity is already.
Well, thank you very much, Samuel Gishohi, Head of Business Development at NCBA Investment Bank Brokerage. And that was the market analysis. I'm Noki Kimboy.